Welcome to Subramani. I have handled this question many times, and so one more time, because people don't go back and search, right? So I've been asked this question, should I keep averaging in a share that I have bought, right? And there is a lot of evidence saying you should, and I can give you enough evidence saying you shouldn't, right? So first of all, understand a particular share is not an index, right? A Tata Steel is not Sensex, right? An ITC is not Sensex. HDFC Bank is not Sensex. So why this is important is because a single company can go up, can go down, and it can go down and stay there permanently when something goes wrong, right? If there's a family fight, and we've all seen that, right? We've seen when there are family fights happening and it remains unresolved for a long period of time, the shareholders lose a lot, right? Or the company could just go out of business, the market share could fall, Amazon could hurt it, there could be some disruption, any of these things could happen. So it is very difficult to keep averaging in a particular share because the market is telling you something and you are refusing to look at that the fact being thrown at you. Like let's take the example of Coal India and ITC, which were both similarly priced at about 330, 340, right? And then the government made its famous announcement that we are going to sell these shares on an ETF, through an ETF, right? Which was perhaps the stupidest way to sell. But well, that's what exactly the UPA government did. They announced that they are selling it through an ETF, which means people like me could exactly know how many shares of Coal India or SAIL or L&T or ITC I would get in that package. So buy it, go to the manufacturer and ask for the underlying securities and be able to deliver. You could put perfect dates to it, which meant it was very easy to go short on Coal India, even SAIL perhaps, I don't remember, at least I remember Coal India and ITC. So that hammered the hell out of both these shares. So ITC fell up to 170, I think, I'm not sure whether I saw prices much below that. And Coal India saw a price of 120 because I bought at 120, I remember. I didn't buy ITC, and that's a personal reason why I didn't buy. But I sold ITC, I had ITC and I sold ITC, right? So you have to understand that if you had kept averaging from 330 to 120 in case of Coal India and 330 to 170 in ITC, today in retrospect it looks like, oh wow, fantastic, brilliant strategy. But that is with retrospective lens, right? When you can see the future, you will be able to do it. But if you are unable to see the future, you will not be able to do it. The problem is, the companies which have stayed on till today will tell you, look, if you had done an SIP in Hindustan Unilever, HDFC Limited, HDFC Bank, TCS, Infosys, any of those shares, right from day one, if you had done an SIP, this is the kind of return you would have got. Mathematically correct, emotionally impossible to do. Because at some stage when you see your share price going from say 330 to 120, would you have the heart to buy more shares at 120? The answer is no. Would you have bought ITC if you had started averaging at 330? Would you still be averaging at 170? That is the question to ask. It is easy for people with tons of income, right? So let us take a case of a person with say 3 crores, 4 crores of personal income from past business, some annuity has been built in, and then that person says, oh, I put all the money that I earn. Obviously, when your income is 3 crores and your annual expenses are say 6 lakhs, that is 2% of your annuity. You can afford to fool around with 98%, right? That is the kind of surplus that you have. Does that make sense for somebody earning 50,000 rupees a month? Can he keep on putting all his money into one share and find that one particular share is 70% of his portfolio or 80% of his portfolio? No, mentally it is impossible to do that. Maybe there are people who have done it and benefited. God help you, God bless you. I would never be able to do it. Yes, at a particular stage of my life when I have so much of a surplus, I am able to talk about these things, right? I have some shares in which I built up a huge position. I would never have been able to buy that much, but it has, yes, splits and bonus and selling some, buying it back, etc. I built up a big position. So yes, today I can talk about it because my dividend income from maybe 1 or 2 shares is enough to take care of my household expenses. So how much is the money that I can plow back? All the appreciation which has happened, I could shift from one share to another. The money that I earn by giving lectures, etc., is something which is a surplus which can get invested after the taxation, of course. And all my dividend income, because a very small portion of it is getting used, I could invest all that. So my situation is different. I can even do an SIP in a single equity share, though it makes no sense except with retrospective effect. You say, wow, this is the kind of return you could have got, and said, I mean, with the backward looking lens, you can say this is what you would have got. But if you were to do an SIP in an index, understand that the index can go down, it can remain down for some time, but it will bounce back. So if you were doing an SIP in, say, February 2020, and you did not stop the SIP for 5-6 months or whatever, you did not pause it at all, and you said, okay, I have got enough income from some sources which were not impacted by COVID, and you continued your SIP, you would have earned money. But would you have earned money in a single share? Depends on what happened to that share afterwards. Did that company get completely wiped out? There are some companies which would have suffered a lot during COVID, which never had the capacity to come out of it, right? So if you do enough research, you will find them. So in such situation, what happens? So if you want to do an SIP, it is recommended that you do an SIP only in an index. You could self-create a portfolio, but then you have to buy all the shares in the same proportion regularly, right? That's what you have to do. I'm saying create a box of shares, maybe drawn out of the index, and you say, oh, say Sensex has 30 shares, I want to buy only 22 shares, I want to be more focused. Right, or invest in a focused fund. Doing a SIP in a fund makes sense because you're doing an SIP in a portfolio. Doing an SIP in an index makes sense because you're doing index is also, for all practical purposes of investing, it's a portfolio of shares, right? So doing an SIP in a box of income producing assets. Let us not talk of one particular fund or one particular share. If that box has equity, it has got real estate, maybe REITs, it has got foreign equity, it has got Indian equity, it has got gold, and you have created that dabba. Let us call it a multi-asset dabba that you have created. Not a multi-asset fund, but a multi-asset dabba. Doing an SIP in that multi-asset dabba, that is, you give me a box where I say I will invest in these things, and I say you keep on putting money into that box. How much return you will get, I don't know, but I can show you that this is the return on an annual basis. This year it was 12, this year it is 11, this year it is 33, this year it is minus 15. I will show you, but I have no clue what it will look like after 10 years, 15 years, 20 years, because I can be very optimistic or very pessimistic. I have no clue whether it will give you 8% return, 12% return, 18% return, I don't know. I can promise you only one thing. I can promise you that it will give a return which is better than inflation. So inflation adjusted return could be 1 or 2%, and it is tax efficient because you will pay tax only when you withdraw. This is the only promise that I can make you in this dabba of multiple assets, which is a multi-asset dabba. Nothing else I can say. Is the risk high in this dabba? Yes, there is a high risk in this dabba because this dabba itself can stay low for, say, 1 year or 2 years. But since you don't require it for 30 years, you shouldn't worry about that fluctuation. This is all you can do. So doing an SIP in a single share does not make sense, because you have to understand that very many companies fail also. It is not that they don't fail, and some of them could underperform the index, right? So if it does underperform the index on a 5-year basis or on a 10-year basis, does it make sense to do an SIP? Forget a company which is not gone fat. I mean, an Orke or a Silver Line or a Pateja Forging have just vanished. So there your money has gone to zero. But even if a company has given you a 12% return exactly at a time when the index was giving you 13.25% return, does it make sense to do an SIP in a single stock? To me, no, it does not make sense. But at a much higher surplus level, if you want to do, you can still do it, but at the lower level, indexing still makes sense, or finding one good fund manager and you being happy doing an SIP with him. I found them 20 years back. I have done it. Now I'm again looking for fund managers, because most of these Prashant Jain has already quit, and Naren is perhaps 2 years away from quitting, right? So then you have to keep looking for new younger fund managers, right? Anand Radhakrishnan is still younger than me, so I have some more time. Yes, there is Roshi Jain, there are others who are there, and there is of course Chirag at HDFC, right? So there are good fund managers, it's not that, but I need to find them, I need to trust them, and I need to do an SIP in those funds. Fund SIP, yes. Stock SIP, risky. Be careful. For people with a lot of surplus, it's easy to say that, but doesn't mean that you should do that. Look at your circumstance. That is more important. Don't look at what gyan we people can give. My situation is very different. I am not paying for my daughter's school fees. I am not paying for an EMI. I stay in my own house. I have a rental property. I have dividend income. So what I tell you, what is applicable to me may not be applicable to you. Thank you.